I'm Jen, and welcome to another episode of Blockchain Banter. Today, we'll be talking about UniswapX, kind of going over the key takeaways, the benefits, the criticisms. Um, I want you all, if you would, to first introduce yourselves, and then we'll kind of jump in. I think it's Guy we have behind the Open Ocean account. Is that right?
That's correct. Good morning, Jen. Thank you very much for inviting us and happy to be here. Happy to speak to everybody. My name's Guy. I work on the ecosystem development team at OpenOcean. It's my responsibility to focus on our partnerships, our network of platforms that we work with, as well as looking after our community and make sure everything keeps on ticking over just fine. So thank you very much to be here. Looking forward to getting into the weeds about Uniswap.
Thank you so much for joining us. It's nice to have you back and looking forward to it as well. Stefan, would you mind introducing yourself for us?
Yes, I'm Stefan Lesch. I'm a contributor to the Banker protocol, working mostly on the economic side. So I often introduce myself as chief economist, even though this is not quite it. But yeah, that's sort of my thing. Economics, finance, a bit of technology.
Great. Thank you so much. And Mark, if you would, please.
Certainly. My name is Mark Richardson. I come from an organic chemistry background. I've been with Banquo since 2021 and have taken over leadership of the project since October of last year after the development of the Carbon protocol, which is essentially an on-chain limit order system with a few other bells and whistles that I speak about in other panels, but I'll try and keep the commentary surrounding Carbon relevant as it pertains to UniswapX for today's call.
Well, thank you. So I've read about UniswapX. I think the more I read about it, the more I see that everybody's kind of digging in and reading between the lines. And I'm interested to definitely hear what you guys have to say. I've read a lot of the comments and comparisons and criticisms of it. But before we get into kind of the nitty gritty, I just want to start with a super high level, of what exactly UniswapX is. And I guess the easiest way to do that is to, go with how they describe themselves. And that is a new permissionless, open source, auction-based protocol for trading across AMMs and other liquidity sources. Um, Maybe we can talk about permissionless, okay, open source, okay, but the auction-based. Let's talk about that for a minute. I don't know if any one of our panelists here want to speak to it specifically. Stefan, I just saw your message. If you're not hearing us quite well, maybe you can drop and rejoin. Cool. Okay, so hopefully he'll rejoin and be able to hear us a little bit better. Mark or Guy, do either of you guys want to explain what an auction-based system is, kind of how that works a little bit?
Well, I mean, they're using the Dutch auction system, which is in a sense like an auction the other way around, so to speak. So let's say I want to do a swap on chain. I load that swap into the system, and so my swap is then put out for fillers to then auction, right? So people are gonna bid on the most competitive pricing based on my swap, and sort of flipping it on its head and doing it the other way around. Like you said, what we call Dutch auction. It enables a sort of higher fulfillment rate as we've got more people competing to be able to execute that transaction, as close to their profit margin as possible. We're looking at significantly increasing fulfillment rate using this sort of reverse auction style, and it also incentivizes our fillers as well to compete for the best price possible. So ultimately, those who are using that kind of style to implement their buys, those users who are relying on that auction style, are actually getting more advantageous fills based off the fillers bidding for that particular swap. I think I'm pretty I'm pretty sure that's a sort of very base level overview of how it works. But yeah, I mean, utilizing the auction style, like I said, increases that fill rate and pushes that competitiveness even higher. It takes the reliance of the user of making sure that they've necessarily found a good place to trade, a good platform that they're trading on, and pushes that requirement back to the fillers on the other side. So a little bit of an overview of how that auction system works.
You can think of it like any Dutch auction. So one of the places where Dutch auctions are most commonly performed is when you're trying to get rid of produce, for example. So when, like, let's say someone has farmed a huge number of pineapples, for example, rather than take that directly to consumers, which, maybe they'll do that via a farmer's market or something like that. But really, the distribution system is the thing that they're relying on. And so there'll be a bunch of, supermarkets and other venues that are going to try and purchase pineapples directly from the producer so that they can mark it up and then sell it on to their consumers. And so one of the ways that has been proven to be the most efficient way to discover the price for these things is to basically say that we've got a certain, tonnage of pineapples for sale, and the current price per ton is X, right? Whatever X is. Maybe it's, I don't know, $1,000 a ton or something. I've got no idea what the price of a pineapple is. Then let's say there's 100 tons for sale, and then at the $1,000 price point, someone might say, "Yeah, look, I'll take 1 ton at that price, thank you." And so now we're down to 99 tons of pineapples left. And if no one's bidding on it, then you mark the price down, right? Now we're selling it for $999 a ton, or $900 a ton, $800 a ton, and you keep going until every single pineapple is sold. Now, this might seem counterintuitive because it seems like you have an ambition to wait. And in part, that's true, because the longer you wait, the cheaper those pineapples are going to get. By definition, this is how the auction works. However, there will come a price point where one of your competing bidders will just buy all of the pineapples. So, for example, and this is true in reselling markets, is that they will attend these Dutch auctions even though they have absolutely no desire to turn around and distribute them. But when it gets to a certain price point, let's say $500 a ton, they'll just say, "I'll take all of the pineapples, please." And then all of the people that were there waiting for a lower price get nothing. And so they are then forced to deal with this now pineapple broker who's going to say, "Price is back up to $1,000 a ton. And I'm not conducting a Dutch auction anymore. These are my pineapples, and if you want to buy them from me, I set the price." In this case, this occasionally, results in massively inflated prices for things. If you've ever been to the supermarket before and be like, "Wow, why are the prices of like bananas double what they were last week?" or something like that. It could be that this is like one of these predatory, bidders has kind of controlled the market. And there are some like regulatory principles in place to sort of prevent or at least discourage this kind of behavior, but you can never really get out of it because you're really just participating in the auction like everyone else. And so it's difficult to claim that someone has acted in bad faith or anything. They're just exercising their option to buy pineapples at a certain price, and then secondly, exercising their next option to price those pineapples however they want to. But that's the concept. If a swapper is coming through the UniX router and they are trying to sell, let's say, 1 ETH, that is the number of ETH that is now going on auction. And so it will start at a certain price, and if no one takes it, or if no one takes all of it, they will then mark down the price until every last little piece of ETH has been sold off. And so the idea here is that it replicates slippage to in a pretty natural way. Because if you're trying to sell just one ETH, sure, probably someone's going to be like, yeah, I'll take the ETH at that price. But if you're trying to sell like 10,000 ETH or a million ETH or something, then that's kind of a lot of units to move. And it's likely that people are going to stop bidding, or they're not going to start bidding rather until the price is marked down, because they're not convinced that anyone's going to be able to buy such a large number of ETH from directly from the swapper in this case. So the most important thing here is that you get, from the swapper's perspective, something that kind of feels a lot like a normal AMM experience. You kind of get the same type, like from their perspective, they won't know the difference between being front run, sandwich attacked, or just normal slippage on the AMM, and the after effects of however that auction is performed. So yeah, it's from the swapper's perspective, it might not make any difference, but from the people who are allowed to participate in that auction, they basically get a first right of refusal, which means that they can sort of act or take opportunities before anyone else in the market has an opportunity to. And so in that sense, it's very, very similar to just-in-time liquidity. It's just that it's a much less time-sensitive one and a lot more organized. So there are, specific people that will be participating in these auctions and won't necessarily need the same sort of technical competence in order to execute a just-in-time liquidity attack. Instead, the just-in-time liquidity attack is kind of built into the system and is a fundamental component of how the routing works.
Yeah, I mean, obviously, it is not about pineapples, but it's about tulips. This is why it is a Dutch auction. I think it has been developed at the tulip markets in Amsterdam. And one thing I wanted to add is that auction theory is actually interesting in that auction theory, as usual in finance, it says nothing matters. Every auction design ultimately leads the same result, that you're going to get the bidder with the highest reservation price will actually get that. What is different with different auction designs is how long does it take? How much effort does it take? Can collusion happen? And Dutch auctions are extremely interesting in the blockchain space. And so I've been advising to use them in a couple of instances, because contrary to any other auction, they don't rely they actually don't require communication. Actually, they require communication, but they only require communication once. So in every other auction, you might need communication from the buyers, potential buyers, because they bid the prices up, which is like a lot of back and forth. And this really needs to happen in a synchronous manner, because otherwise there is a problem. And some auctions even rely on secret, on the ability to submit a bid secretly, which again in blockchains is a little bit hard. I mean, you can do this, but it's hard. While the Dutch auction is super easy, it's just like, okay, the price is literally just a function of time, and you jump in when your reservation price is met, which is kind of the optimal strategy for a Dutch auction. If you want to buy it, you just jump in when your reservation price is met, which is for ETH, whatever price you can buy somewhere else, plus whatever your risk premium or fee you want to earn is. Or if you know who else is there, you can kind of have a view on what the second best bid is and play the game a bit there. But well, this may or may not be wrong, because the second best bid might be different. But yes, so it is a super interesting, it's a well adapted mechanism for price finding for the blockchain. And obviously the other thing is that Mark already mentioned this just-in-time liquidity. We've written about this reversal that ultimately, the maker-taker reversal, that ultimately people kind of want to jump in there. The market makers end up wanting to jump in there as takers. And that's also that's an interesting dynamic that then is formalized, probably improving market efficiency. Also, it is a trend that ultimately off-chain routing still has advantages, because obviously people like to think about different AMMs on Ethereum, but people should really think about Ethereum, or possibly even all chains together, as a single AMM. Because if you route big order through multiple exchanges at the same time, this is how you get best execution price. But this means you may have to do off-chain execution, which most of the time is not a problem. You do it with 1inch or whatever. Obviously, if you want to do atomic transactions, then you may or may not be able to do this, which is a bit of a shame. But this is kind of the trade-off that you have to take into account.
You guys brought up a few interesting points that I want to touch on. I want to first welcome DeFi Cheetah. I'm glad that you're able to join us. Thank you so much for being here.
Yep. So basically, actually, what concerns me about this would be actually I find UniswapX is a bit overlap with Flashbot Swap somehow, because in Swap, what I understand is basically the searchers would be the exclusive right of the order flow of the people and the trader, and then the trader will get the kind of sign the the whoever has the highest bid to them, and then it's kind of like a MEV rebate to the trader. And I think in terms of the MEV protection of UniswapX is come out somehow works similarly using the Dutch auction, which I won't elaborate more, as it is already elaborated by other guest speakers. So I would like to know, because I saw Dan Robinson once said on a tweet that UniswapX could be built on Swap. So this may be something that would arouse my interest in this part. But otherwise, I find largely it is similar to the combination of CowSwap and the Uniswap v3, except that it is quite different, because in terms of the design compared to CowSwap, the solver system is a bit different from the UniswapX Dutch auction, because in CowSwap it is provisioned, but for UniswapX, the team claimed it later on would be permissionless, and anyone could bid the order flow according to the Dutch auction mechanism. So let's see how that works. I think this could be something that is interesting if it is also built on the swap. But yeah, let's see.
You mentioned the MEV, and I definitely want to get to that. I want to backtrack a little bit. So Mark, you mentioned, the people that are allowed to participate in the auction, and Stefan, you had mentioned, in DeFi, it's important, like how long, how much effort these participants are, like how this goes on, and it's interesting for the blockchain. But when you are, and this is an open question, when they're saying that it is, AMM liquidity and private liquidity and et cetera, it has implied that it is centralized exchange liquidity as well. Is this one of those trade-offs that you were speaking to, Stefan, in terms of, execution and efficiency? Because it's raised questions, and I'm curious your take on it, how decentralized, how DeFi this may actually be. And Guy, I'd like to hear your input as well, because being an aggregator, you said our, which makes me think that you might possibly have system that you guys use with OpenOcean?
Yeah, I do think that the decentralization doesn't seem to be an issue. I haven't fully dipped into these Permit 2 and their router contracts, but I do think if they work as advertised, then this is a really, really interesting system that allows you to have a decentralized front end onto all kind of other venues. Now, the fact that someone, possibly anonymously, possibly not, goes to a centralized exchange and sources the liquidity to fill the order from a centralized exchange, I don't think is a decentralization issue. The decentralization happens at the point when you put this order, so you do this RFQ, you get your best quote back, but then you initiate this this Dutch auction thing with this exclusivity period at the beginning, and then the Dutch auction just goes down. And at this point, it's decentralized because, well, if it's true what it's what Uniswap says, and I have no reason to doubt it, I just haven't found it myself, then anyone can jump in and at the right time, yeah, take up this order. Now they're all kind of interesting questions: is whether this runs on the open chain or whether this runs in some MEV hardened pool, and when there is an MEV hardened pool, there might be all kind of. This pool itself obviously is not decentralized, so people who run this pool may be blocking access to it, but maybe it also runs in another pool. So I'm not quite sure what the universe of people is that see this order and can fill this order, but a priori I have no reason to doubt that it's sufficiently decentralized or very decentralized.
Okay, fair enough. The next question that I had, and this is something that, you know, DeFi Cheetah, you had said something about the flow, right? So I was reading a comment from someone that said passive LPs become the liquidity of last resort. They only receive flow that RFQ participants don't want to fill. That is the most toxic flow. So really quickly, RFQ is an RFQ system in this case the same as a Dutch auction. I didn't see RFQ in the UniswapX announcement, but I think that it's being used in the or referred to as the same. Maybe.
Yeah, actually, I think for the comment, I actually concur with the view that with UniswapX, actually LP should be the one that would be more or further exploited by the fielders in that part, because especially because when someone, because I perceive that could be someone that actually front run the LP, because the, the fielders or the or whatever or RFQ or whatever parties that are bidding for the Dutch auction, in some sense they are actually uh, the one that front run the LP to be the counterparty of the trader. So if they don't feel the price, those order flow would be more toxic than usual. So that's a very logical thing. But so that's why I think what I would like to bring in the issue is that whether DApps or searchers should be the one that is participating in the bid, because if it is DApps that would be the main party to create this kind of auction system, LPs would be the one that would be most exploited. But if it is by the searchers in the swap system, so that could mean that after the traders interact with the LP for this kind of trade, searchers by bidding the highest possible price in order to get the order flow, they need to kind of refer a huge amount of MEV back to the traders. So in that sense, it would be less toxic because I think it is a bit subtle, but I think it's mainly due to the difference of the party because and due to the difference of the order because in that sense it is about who get the price first. So I think that would be something that's different. If I'm wrong, so let me know. So, but my understanding for now is like this.
I don't know if any of our other panelists want to add to that at all, but
Yeah,
go ahead, Mark.
no, DeFi Cheetah is 100% on the money. So the way that you can think about passive LPing, if we want to call it that, even on Uniswap v3, is that you really benefit from market inefficiency. So if someone's going to perform a swap via Uni v3 today, before UniX is live, then that trade is just going to go through, and all of these people that would have happily taken that trade, they're forced to back run it after the trade has already happened on Uniswap v3. And as an LP there, you're happy for that inefficiency because it means that the trade first goes through your liquidity where it may traverse the bid-ask spread or at least push a little bit further in one direction. And then as someone back runs it, it then moves back the other way, like either from your asks into your bids or from your bids into your asks, whichever direction the trade happened to move in. And so with a system like this one that is resolving the swap before it touches the AMM, it means that that fuzz, that jitter in the market that is essentially the sole source of returns for LPs, which are already pretty thin. That's good. That basically goes away with a system like this one. And depending on what your level of erudition is in AMM theory, one of the ways that we might model something like this is how much of that jitter is actually there. And if it's not there, is it because the market is moving in exclusively one direction? So for example, imagine that the price of ETH goes from $1,000 to $1,500 in the course of a single day. Now we know that that's not because of like one trade or the fact that every trade is just buying ETH off of the market. There's always going to be at least some amount of counter trading happening in the other direction. And as an LP, that's what you want, right? Even if the price of ETH goes from 1,000 to 1,500. Even though the IL associated with that is significant, as long as there was enough volume moving backwards and forwards through that range, and this is important, it has to move both directions, then you might actually accumulate sufficient, air quotes, fees in that process to sort of offset that IL exposure. But if these first look market makers are going to resolve the swap before it touches your liquidity and only let it go through if they have no interest in taking that trade, then it could be that wrinkle is really sort of ironed out. Really, it goes really, really smooth. And rather than getting sort of a forwards and backwards momentum as the market sort of reestablishes itself, you might instead just get a smooth trajectory to one side. And that essentially means that there are no fees, right? If you're only capturing that macro movement, then you can actually show that Uniswap v3 and any AMM actually receives zero fees, because what we call a fee, and I've said this many times before, is really just a bid-ask spread. That's all it is. And so if there is a trend and these auction participants only let through the trades that are sort of agreeing with that trend, then then essentially you never get to cross your bid ask spread, and you get that kind of over toxic order flow, which is what DeFi Cheetah is referring to. But he's right on the money with that. There was something else I want to raise, which is that we've already mentioned RFQ a couple of times in this call and in different contexts, but it should be pointed out that this Dutch order system, this Dutch auction system is not RFQ, right? For an RFQ system, if you've dealt with ordering precious metals, for example, in general, what you'll do is you'll place a request. Say that you want to buy, I don't know, 100 grams of gold or something, and the exchange or the broker really will deliver you a quote, right? This is how much I'm willing to sell 100 grams of gold to you for. And then you've got a certain time period in which you can act on that. It's, depending on who your broker is, it might be quite short, like just a few hours, or it could be up to a day. But that's your quote. And no matter what happens to the market, you've got the option to exit to basically accept that quote whenever you want it. And that's it. You take it. So this is not an RFQ system. If it was an RFQ system, you would go to Uniswap and say, how much can I get for my ETH? Like if I want to give you guys 1 ETH, how much are you going to give me in return? And you would receive a whole bunch of quotes, right? And you would decide which one to take. That's not what's happening here. If anything, it might be RFQ in the opposite direction, where the people that are participating in the Dutch auction are getting the quote. But even then, it's not entirely true, because in a request for quote, the number of things being sold is a part of the quote. You don't get to decide after you get the quote that you only want to take half of the things. It's an all or nothing type system in general.
Mark,
yeah, go ahead.
I think there's a 2-step process there. So the first step when you want to trade, it's an RFQ process. You tell to the market, I want to buy 1 ETH. And then fillers can come back and they say, I'm happy to do this, I'm happy to do this, I'm happy to do this. And there, the highest bidder, at this is an RFQ. And then the person says, okay, I'll accept this RFQ, possibly. And then the one who has placed the best quote has a very, very short period to actually fill this trade and has an exclusive period on this one. So in step 1, UniX is an RFQ system, and this RFQ system actually serves to anchor the price where you want to put your Dutch auction. Otherwise, it's a little bit tricky to put the Dutch auction into a place where it is fine. And the Dutch auction then starts 2 or 3 blocks after this was accepted. So that initially there's just, I want to buy that. You get this to, I want to sell that, so I want to make this transaction. You put it to the market. You get the quote responses back. And then you sign this, what they call an intent. Yeah, so the intent then is an executable transaction. That is then fed into the Dutch auction. And at this stage, the best bidder on the Dutch auction has exclusivity on a short period, and then the Dutch auction starts. So it starts with an RFQ process and then segues into the Dutch auction. This is my understanding of the process. I may be wrong, but I think this is how it works.
Okay, so I want to shift back to one of the things that Mark also said, which is, you were saying that there really are no fees. It's more of a bid-ask spread, and we've mostly spoken to bid-ask spreads with limit order systems. Another question that I saw from someone was, do these fillers play a counterparty role to swappers, or do they just act as agents for the swappers? And if fillers are indeed a counterparty, then is this an order book model? Is this good?
Yeah, I think it's a bit. It's a technology that is really quite interesting, because this goes with their permit to and routing contracts and stuff. So the counterparty, I think, if I understood it well, and I need to dive more into technology, is effectively this contract, because this contract is because they deal with ERC20 token, and ERC20 token you need to give approvals to work with them. So I think the effective counterparty, or the counterparty as far as the ERC20 token is concerned, is this router contract. And then this router contract deals with these intents, and these intents are a signed transaction that's a signed message. It's not a transaction, it's a message that says, I'm happy to sell this against this at a price that decreases from here to here until this point, and then I withdraw the order or whatever it is. And you kind of trust the router contract that the intent is fulfilled. Well, you don't need to trust it, you can check it, because the router contract is obviously public. And the router, as you see it, like if you think about a clearinghouse sense, the router contract is actually the counterpart that you see. The router contract is a bit like a clearinghouse. And then whoever deals on the other side, like in traditional finance, you don't really care, because on most exchanges nowadays, you have this order novation. You have a buyer and a seller, but the buyer and the seller never meet each other because they both execute through a clearinghouse, and effectively the clearinghouse deals with it. Now that's a bit more complicated, I think, because the filler is not obliged to post collateral initially, so the other side obviously has the approval. So I do think there could be fail to deliver situations, but ultimately you never interact with the filler, is my understanding. It's rather you interact with the routing contract, and the routing contract then routes it to the filler somehow. But I don't entirely know how it works with time delayed things, and I do think you can have failure to deliver, because ultimately they want to do cross-chain swaps, and cross-chain swaps you can't have immediate delivery, right? You might have to wait a week for cross-chain swaps to deliver with certainty.
Okay. Let's move on to the MEV topic. I know it was brought up a couple of times, and I want to make sure that we have time to talk about it. I didn't realize we were 40 minutes into the call already. Something that I had seen was someone commenting, Uniswap has said that they solve for MEV, that there is no MEV in their system. But a comment that I had seen was one significant consequence of these designs that use solvers and fillers and executors is removing the stigma from MEV, searching by repurposing the MEV searching system to perform the solver filler role. So, I mean, is this sort of system, is UniswapX actually, and they said it themselves, right? Let me see what they actually said was that MEV that would be left on the table to be captured by an arbitrage transaction is instead returned to swappers through improved prices. Are they actually eliminating this MEV? Are they protecting against MEV? Or are they kind of repurposing it like this person had said on CT? And I'll pin it to the top as well.
From what I've seen, I haven't looked too much into how Uniswap v4 is discussing MEV, but from the role that we know that hooks are able to play, obviously, in smart contracts, we can see a lot of different ways that pool deployers and these hook creators can effectively basically deal with, let's say, MEV profits, right? So if there's a large trading pool, for example, we could have there could be a hook for specifically that's used to capture specific MEV profits, if there were any to be made, and then distribute those back to the source LPs. It's interesting from a MEV perspective, and they've said, the Uniswap team has said that with the new structure that we'll be looking at less instances of aggressive MEV attacks. But I think what we're seeing here is an attempt at a sort of base level to like internalize those the sort of MEV benefits, and obviously like some of those can obviously be attributed to the swapper, ideally with lower fee, lower transaction prices. But and then again, if we can route those back to on the fill side, we can maybe look at utilizing those hooks and returning those profits to pool participants. So yeah, I can't speak too much detail into the MEV benefits of UniswapX, but I mean, it definitely is great to see that there's sort of definitely some composability in regards to the fees that these are generating.
Cheetah,
I think it comes. Oh, sorry.
oh no, that's okay. I just saw that.
Yeah, I was going to say that it comes back to auction theory. I think this claim is rooted in auction theory, which says that if you have a properly designed auction, then people will bid themselves up in a competitive auction. You get the marginal price, and the marginal price is whatever the risk-adjusted cost of filling this order is. So the risk-adjusted price of filling this order is kind of the best price it trades elsewhere. Plus, if there's sort of some execution risk for you in the middle, then you want to put something in. You might want to put also like $1 or $2 or $5 or whatever for you to bother to do this, and you want to be paid for gas. But you're not gonna make extraordinary amount of MEV if the auction is well designed. But of course, every auction can be attacked. That's the interesting question of how robust it is. So one way I see, but I don't know the technical details, but obviously the way to attack a Dutch auction is just shutting everyone up. Yeah, it's essentially when you manage to get some kind of denial of service attack there, and you just have the clock run down, and then you jump. If you know that you're the only one to jump in, then this is the equivalent of MEV. The question is, and I really don't know at the moment because I'm not that much into the system, whether there is a way in this particular configuration where someone could be in this position and could be should prevent other people. And even if they can only know they can prevent them for 2, 3, 4, 5 seconds to place bids. In this case, they know, well, they're going to bid just before it becomes open, and then these 5 seconds delay arguably is the equivalent of MEV. But I think we really need to look into this auction design then, and really the technicalities of whether this auction can be attacked.
From my side, actually, I have two aspects to address. The first point would be actually, I think some may say that compared to UniswapX, CowSwap, because it is the solvers are permissioned, so that gives rise to a problem that because it is also not using a Dutch auction. So basically, solvers with the best price doesn't mean that traders get most or get most of the values to be rebated. So I think this is different if it becomes permissionless because the pricing would be more competitive. So traders would get back more from what they got. So this would be a kind of small improvement if we assume later on UniswapX becomes permissionless. This is the first aspect. But the second aspect, as mentioned by Oscar, I think we need to know how the auction is actually designed in order to see to what extent it can address the MEV issue. Because my initial understanding, I'm not sure if the fielders and the searchers are the same type of people. Because I think we need to review kind of the MEV supply chain because for MEV, those who extract MEV could be kind of aligning a few transactions and inserting or by reordering the transaction into a bundle, and then they can, in that sense, extract the value by ensuring that this bundle would be the next block to be proposed by the proposer. But the point is that I'm not sure if failures are possible, because the intent expressed by the traders are off-chain at the initial process. So I'm not sure how, if I assume those failures and MEV bots are the same type of people, I'm not sure how they could configure this stuff and to make it on the chain. So in that sense, actually, I'm on the side that I don't think DS would be the best place for protecting the MEV, because there are some off-chain elements, and is not easy for the MEV protection to take place compared to what I just mentioned about the Flashbots swap design, because compared to the UniswapX, I think swap design would be more, if you are concerning the MEV protection, it's more to that point, because at the end of the day, swap directly force the MEV boss to compete for the bid. And by whatever means, like if they have those with the highest capability to extract the most MEV would tend to bid the most of the values, and then those values will be rebated to the trader in order for them to secure the order flow. So in that the order transaction. So in that sense, they could do it with kind of whatever sandwiching or whatever to extract the MEV, and then those will go back to the proposer. So it's a kind of shifting the MEV now extracted by the proposer or the validator through the MEV boost back to the traders in that sense. So I think in the second aspect, I don't think DS would be in a better place than the swap-like sequencing function blockchain. So I think it is a kind of confusion that at least confuses me. Not sure how both parts could work out, and also it arouses some kind of confusion, because I'm not sure if fielders and MEV bots are the same type of people. But what I can assure you is that at least LP, as explained by Mark, will be the one that would be most exploited, because at least there would be less volume going through the LP, and more kind of transactions that are not selected by the those fielders would go to AMM, which probably could imply that those order flow could be more toxic than usual. So yeah, this is my take.
Yeah, it's a super interesting point as well that DeFi Cheetah is raising about the relationship between who's participating in these auctions and whether or not they're a part of the searcher networks or even the block builders. I would expect, or at least I think that it would be naive to assume that they won't be. We already know that a lot of these order flow systems, like what we've already heard the comparison to flashbots, but we know that there are other order flow systems that are competing with flashbots, or will soon be competing with flashbots. And I would expect that UniswapX is no different. So there is going to be this other component, and to say that it is that it is protecting against MEV. I mean, I get it, because to some extent, things like sandwich attacks and so on aren't really relevant conversation in the system, because the only way that a sandwich attack becomes relevant is if, let's say, the auction fails or no one participates, and the trade is eventually routed through Uniswap v3, then it can be sandwich attacked and so forth. So you don't really get out of the woods that way. But if you're if your trade is being filled by people with access to private capital, then fine, right? I'm willing to pay that is at least more MEV resistant than, or at least you could actually just say it is MEV resistant. But I think that the point being raised here is that what's the difference? Just because you're not being front run or sandwich attack doesn't mean that there aren't other mechanisms that we don't historically conflate with MEV, but would have more or less the same outcome at the block building level and search and network level. So it'll be interesting to see how this kind of stuff evolves.
I have one last question for you guys, and this is a little bit more of a general question, just because we're coming up to the hour now. I saw a comment that somebody was saying that with Uniswap moving to more of a centralized off-chain RFQ system, it's an admission that a sustainable, fully on-chain DEX is not viable on Ethereum. And I'd like to hear your opinions on that.
I completely disagree with the direct competition between order book and AMM because I think they serve different functions. At least there are some, because if this thesis only is true when there isn't nothing for AMM to be value added than order book. But I think there are at least something that order book cannot outpace AMM. For example, like the composability, because nowadays the liquidity that is deposited into the AMM could also serve other purposes. But for order book, because not every order really needs to hold the kind of money behind the order, and the market makers could withdraw those orders if some of other orders are filled. So this is more efficient in a sense that the professionals are making the market and creating a seemingly more in-depth liquidity. But somehow it may not be as deep as it is, because you won't know how much capital actually held by the market maker to make the market. So this is something that to take the note. But I think for this kind of composability, I think it is very very hard for order book. For example, like if someone are professional enough to make the market, they are making the market only, and you cannot kind of get some kind of right from this kind of stake in the order book system to do other stuff. So the whole DeFi Lego is actually built on this kind of things, and I think this is something that it is hard to be done in a traditional way. And the second thing I would like to raise would be there would be kind of like what I could picture is like this: assuming there are some other obstacles that could be overcome, for example, like the gas, assuming later on the gas fee could be cheap enough so that the on-chain or the order could be completely on-chain. I think some kind of blue chips, for example, like BTC and ETH, could be more traded in the order book kind of system. But in terms of long-tail asset, I don't think it is that easy for market makers to make the market for those long-tail assets, because they are not those who are willing to take the risk of those long-term assets, especially if we would like to have permissionless lending on DEXs. I think this is very important, because let's refer back to TradFi, and we can see for those less popular stocks, it is there is very less orders in the order book, because the market makers are not really out there to make the market, because you can consider those less popular stocks to be like long tail assets in crypto. So for new projects, it's very hard for them to get the market making from professional market makers, and it is the kind of how AMM could work out, because those who like new projects who may not gain the reputation at the initial phase could be able to bootstrap its liquidity through different incentives. And those who are willing to bear the risk, for example, retailers may be more. Someone may think that, are you implying that those retailers are more stupid or whatever? This is not. It is more about risk profile. Retailers may have a more aggressive risk profile than market makers. That's why those incentives could attract those retailers to kind of provide the liquidity and make the market. But if you're talking about order book completely replacing the AMM, those with a high risk profile could hardly take this kind of make the market because they are not with the capacity to do so. Or if they have the capacity to do so, they may need to kind of give the custody to professional market makers to help them do the job. That means we are reverting kind of back to TradFi because it is no longer self-custody. It is again being managed by professionals. So this is kind of degeneration somehow, I would say. So I don't think order book and AMM are completely mutually exclusive. So this is my take.
Thanks so much, Cheetah. Mark or Guy or Stefan, if either of you want to add to that, I know we're at the hour, so.
Yeah, just quickly, I think there's a lot of wisdom to what DeFi Cheetah has just said, and I don't think I can actually add anything extra on top of what he said, but maybe just sort of clarify my exact view on precisely the same talking points. AMMs, like when they were invented, was to serve a very, very specific use case, and this was for the long tail of cryptocurrency, and it was largely the focus of Bancor when these things were first implemented, that projects would provide their own liquidity. And when you've got no one who is willing to do the RFQ or to make markets for you in a professional context, then really there is no other choice than to use an AMM. And yeah, like we've figured out, over the last couple of years that there are ways that you can kind of, rest on your community or sort of share the burden with them in order to create markets for you by offering them token rewards and other things to help bring some cash into the system and make the token liquid. And whether or not you feel that that is, ethical or not is besides the point. It is apparently a legitimate use case and something that people are excited to participate in. And there's just there is no replacement for it. AMMs, I think, will always serve that specific purpose. But the point is, when you have that specific view of an AMM being explicitly to service the long tail, that the liquidity that's provided to those systems is not necessarily expected to be financially performant. In a way, it's expected to not be financially performant. It's more of like a cost that's borne by the project with respect to making their token liquid, and it's not even that bad, right? Sure, like they might lose some tokens, and as the token goes up in price, but you have to. It's kind of a catch-22 because had you not provided those tokens to the market for sale in the first place, then their token price wouldn't have appreciated at all. And so the only way to have no IL is to not sell anything to the market, which doesn't make a lot of sense. So I think from the project perspective, there will always be this AMM use case. But I think
Did I lose Mark myself, or did we all cut out?
Also lost them.
Yeah, also lost as well.
Mark, are you still with us? Oh, I just got a message from him that his phone died. Okay. Well, go ahead, Stefan.
Yeah, just sort of my thing. The one thing I want to mention is what I think actually is the most exciting about this whole thing is intent and the baby steps towards the whole implementation that is this perma 2 contract. Because I think this intents have a massive design space
in this area, which goes well beyond just the narrow area that we are discussing. That you essentially have a signed message where you say, "Look, I'm happy to do X under conditions Y," and you sign it, and then everyone who can have it, everyone can execute against this message, which generally is also time limited. I think this is a really, really nice design feature.
Well, and on that note, Mark asked me to apologize to everybody. Stefan, thank you so much for adding that at the end. DeFi Cheetah, I'm glad that you were able to join us. Guy had to jump to another call. I tried to keep it at the hour. Thank you guys so much for getting up here and kind of dissecting this a little bit and digging in a little bit deeper. Stefan, you unmuted. You want to?
No, wrong button. Just so to say thank you. It was very nice.
Okay. Well, thank you guys again. And thank you to all of our listeners. We have another blockchain banter on Friday morning, followed by our coffee break on the Bancor Discord. Definitely hope that you guys can all join. And I hope that you enjoy the rest of your day or evening or wherever you are, whatever time it happens to be. I hope that you have a good one. Thanks so much, guys. And we'll see you next time.
Thank you for the invitation, and I think the intellectual exchange in the blockchain banter could help every one of us to understand more deeply about what is recently being so hot in the crypto space, and I hope every one of you would be taking something back after the space. Thank you so much.
Thank you so much, Cheetah. It's always great to have you. And anytime you'd like to join us, would definitely love for you to do so.